Nigeria Limited, founded on December 20, 2006, is a niche financial information service hub with a key focus on delivering market intelligence, data analysis, research, and news on markets, business, technology, regulation, MSME, personal finance, and economic development. They are organized as a professional practice to provide accountability in our role of opening up the marketplace by complementing regulators, SROs, and CMOs to shape conversations with investors and consumers, advocate on key change imperatives, hold the system accountable in a collaborative manner, and raise the bar through the platforms they have established to conduct their engagement in a win-win scenario. Their goal is to facilitate the information needs of a vibrant, productive, and growing African economy, focused on empowering the productive units to excel and enable individuals to make the best decisions to build sustainable wealth.
Morning, everyone. My name is Abdul Kudus Isiaka, and I'm an analyst at Proshare. I want to quickly get into my brief for this morning. I would be doing an overview of the Nigerian economy for the 2021 year, and we'll also be giving an outlook for the 2021 fiscal year. Nigerian economy in 2021 recorded 3.1% average growth rate, and that was between the period Q1 and Q3 2021. It was largely supported by a low base effect, as well as large expansionary fiscal stance by the government, which supported household demand. Average annual GDP before the pandemic in 2019 was about 2.19%, and that implies that we may well be well out of the woods, meaning that we actually may have surpassed pre-pandemic levels of real GDP growth. In Q1, real GDP growth rate was about 0.51%, quite tepid. In Q2 was about 5.01%, much more comfortable, but largely supported again by the low base effect. Recall that in 2020, the Nigerian economy recorded a negative real GDP growth rate of about 6%. And in the quarter that followed, the Nigerian economy recorded about 3% negative real GDP growth, technically bringing it into a recession. But coming back to 2021, in the third quarter of 2021, the Nigerian economy recorded a 4.03% real GDP growth, which was quite comfortable and impressive. Now, in analyzing economic real GDP growth based on sectors, we found that the services sectors, as typical, contributed the largest portion of real GDP in that period. The period between Q1 2021 and Q3 2021. It did contribute about 50% in the 9 months to September 2021. The agricultural sector followed by about a contribution of about 25%. Industrial sector contributed a little above 21%. Now, analyzing real GDP growth again based on the spending by economic agents, we found that the household contributed the most. Of course, that's quite related to large government spending, which stimulated household demand, as mentioned earlier. We found household consumption contribute about 76.83% to real GDP in the first quarter and 73% in the second quarter. Government spending did contribute about 5.92% in the first quarter and 6.33% in the second quarter. Investment, or what you may refer to as fixed capital formation, accounted for about 17.84% in the first quarter and 14.85% in the second quarter. Moving on to PMI, another macroeconomic indicator. The CBN manufacturers PMI came in quite disappointing, much lower than the 50 index point benchmark, which ordinarily suggests expansion within the economy. But we saw PMI coming consistently below 50, the 50 index point benchmark, indicating successive contractions in terms of production. Now, this has been attributed to a number of factors, but most notably the difficulty that manufacturers have been faced with in accessing FX and in purchasing inputs especially from abroad. But despite the abysmal performance, the low PMI, we still found that PMI did rise in the second half of the year, only that it fell short of the 50, again, the 50 index point benchmark. In June, it was about 45.5, and it rose later in October to 47.3, suggesting that the economy continued to contract, but at a reducing pace. Moving on to inflation, because my brief primarily is to take a quick look at some of the macroeconomic indicators, the lagging macroeconomic indicators, and also appraise the complexion of the complexion of the policy environment in 2021, to give an outlook for 2022, and to tease out the implications, strategy implications for businesses, particularly MSMEs. Now, in terms of inflation for the year 2021 came in at 16.98%, and that is much higher than had earlier been forecasted by the IMF. The IMF had forecasted 16.5%. And of course, we know that the CBN typically projects or targets an inflation rate of a single-digit inflation rate. This, however, was elusive in 2021. Recall that in 2019, inflation was about 11.2%, way lower. In 2020, inflation was about 13.4%, a little bit higher, but was still within what you would call the comfort range. But inflation spiraled in 2021, and it did at the end of the year reach 16.98%. Now, average quarterly inflation was highest in Q2, the second quarter of 2021, where CPI growth was about 17.03%. It later fell to about 15.67% in Q4. On a month-on-month basis, inflation was highest in the month of March, when it reached 18.17%, the second highest in 4 years. After then, inflation trended downwards for 8 straight months till it reversed that trend in the month of December, when it hit 15.63%, largely due to buying or demand attributed to the festive period. Moving on to developments with regard to foreign exchange liquidity and liquidity in the external sector. The $4 billion Eurobond issuance by the federal government, that happened last year in 2021. Then a $3.35 billion SDR allocation from the IMF, as well as rallying oil prices, all supported the reserves in 2021. So we saw a 14.55% increase in the reserves in 2021, bringing it to about $40.52 billion at the end of the year. So we did see external liquidity rise, and that perhaps brought import cover to about 9 months, which is quite high compared to previous years. Now, in terms of exchange rates, we recall that in 2021, the CBN did technically devalue the Naira when it adopted the INFX rate. And at that time, the INFX rate was about 410 Naira to a dollar. And this did depreciate towards the end of the year. It did come to around 415 Naira to a dollar. And that was as of November. Moving on to the current section of the BOP, that's in terms of external trade. So total trade picked up in Q2 and Q3 after lagging in Q1. That was largely due to a rally in crude oil price. So we saw crude oil price rise in Q2 and Q3. So the 9-month trade in 2021 reached 35.073 trillion naira, about 50% higher than what was recorded in the 9 months period to September 2020. So our major trading partners in 2021 were China, India, Indonesia, US, and Spain. still on external trade, Nigeria's external trade in 2021 was largely on account of crude oil exports and importation of manufactured items. So we saw crude oil exports account for 89% of our total exports, while the imports of manufactured items, including PMS, account for about 63% of our imports. So this kind of gives us an idea of how important the oil and gas sector is to not just foreign trade, but also the import bill and trade balance. So I think it's apposite to talk about the zero oil plan that was introduced by the federal government in 2020. And the idea behind that was to increase the country's export diversification index. But still, at the end of 2021, we found that Nigeria, compared to other mint economies meaning Malaysia, Indonesia, Nigeria, of course, and Turkey. So of those 4 countries, Nigeria recorded the least impressive export diversification index. It does have an export diversification index of about 0.75, much less impressive than those of other cited countries. Then moving on to the capital section of the BOP. Capital importation in 2021, over the three-quarter period to September 2021, we saw capital importation drop considerably. It did drop by about 78% compared to, it dropped by 78% in 2021 compared to the pre-pandemic levels, namely 2019. And compared to 2020, which was during the pandemic, we saw capital importation drop by about 50%. So this quite defies the expectation. We would have expected that exiting the pandemic, we should see an improvement in capital importation. However, it wasn't quite the case, and the situation has been attributed to a level of insecurity around the country, particularly with respect to the more permanent form of capital importation, FDI, as well as the parallel premium or the multiple exchange rates that exists within the market, the foreign exchange market, and the country's huge infrastructural gap and other structural rigidities that disincentivize importation or capital inflow. Moving on to a summary of the federal government's programs and policies in 2021. So this is supposed to give us an idea of what the policy environment was in 2021. In that period, the federal government passed the finance bill. It was actually on the last day of the year. And the provision, that particular bill provides that a 10 naira per litre excise duty will be imposed on carbonated drinks. Secondly, the finance bill itself provides that non-resident digital companies are to register as VAT collection agents. Similarly, but much earlier in the year, VAT was increased from 5%, VAT rate was increased from 5% to 7.5%. Also, privatization, there was the privatization of the NNPC through the PIA, that was in August. And then there was also the introduction of cost-reflective tariffs for electricity. And we saw 2 hikes in electricity tariffs in 2021 on account of that. Now, on the monetary side, we've seen the CBN trying to manage price stability and stimulate economic growth by holding the interest rate. It actually adopted a centrist stance, holding interest rates from September 2020 at about 11.5%. and relying on more unconventional heterodox monetary policy. And we saw the CRR was held at 27%, the statutory liquidity ratio was held at 30%, and the asymmetric corridor was held at plus 100 minus 700 basis points. In terms of the FX management mandate of the CBN added one more item to the FX restriction list in 2021, namely sugar. It also continued its 5 naira for $1 program, which was meant to improve or reduce the cost of diaspora remittances it was in that period in 2021, we saw the CBN also halt the sale of FX to BDCs in order to curb their rent-seeking behaviors, and consequently directed commercial banks to open teller points, dollar teller points, as an alternative. Now, in terms of its development financing obligation or mandates, we saw the CBN intervene on a number of through a number of targeted credit facilities. There was the Agribusiness Small and Medium Enterprise Investment Scheme, 100 for 100 Policy on Production, Anchor Borrow Scheme, and a host of others. Now, a summary of the 2020 review. So in terms of our outlook, the overall outlook for the global and the domestic economy remains really clouded with a combination of upside and downside risks. Despite optimism, there still may be a need to be cautious. Notwithstanding, we expect the economy, Nigerian economy that is, to grow by between 2.5 and 2.7%, supported again by government interventions, but this would be moderated by the absence of the low base effect, and that kind of explains why the growth wouldn't be as large as what we saw in 2021. Similarly, we expect interest rates expected to be raised in the second half of the year in response to monetary policy normalization in more advanced economies. We think PMI would drag due to higher lending rates, of course, on account of higher monetary policy rates. The PMI would drag. Higher public sector borrowing would also affect PMI and other structural bottlenecks. We also expect inflation to hit about 15% due to exchange rate pressures. And we also think that insecurity would abate temporarily in preparation for the elections. We think food prices would improve due to the bumper harvest from 2021. Likewise, we expect oil production to still remain below the 1.8 billion barrels per day projected in the budget, and that is despite the PIA, Petroleum Industry Act. Crude oil will sell at the international market at between $75 and $85 per barrel. Dangote refineries would kick in, production will kick in the refineries in the second half, most likely in the third quarter of the year, and that should help save the country about $12 billion in FX. So Dangote refineries would begin production in the second half of 2022, and that would help save up to about $12 billion in FX. The PAPSS system, the launch of new ports, Dangote refineries, all will facilitate trade, and we expect trade deficit or trade balance to GDP ratio to reduce, although not substantially. Reserves and the exchange rate would be positively impacted by rising crude oil price, although the backlog of FX demand would also play a role. We will also see the $50 billion trust fund, which is to be allocated by the IMF later on in the year, play a role in shoring up the external liquidity of the economy. Planned borrowing would also rise, so we expect the government to borrow up to about 4.89 trillion naira in 2022 and up to about 12 trillion naira between 2022 and 2023, and that should bring the country's debt stock to about 50 trillion naira by then. But if a substantial portion of this borrowing will be domestic, then it would imply on the cost of, or would imply on private sector lending negatively, and would increase the cost of borrowing generally. Supreme Court judgment, the Supreme Court judgment on VAT collection authority, appropriate VAT collection authority, is also going to be crucial. That judgment is going to be delivered in 2022, hopefully, and that should also imply on the possible rates, because in the event that the state governments are given the go-ahead by the court, or that the judgment is delivered in their favor, we probably could see VAT rates differ in different states. Then in terms of population dynamics, Nigeria's youth population will continue to grow, and some Nigerian cities would increase in population considerably. Now, as they affect MSMEs, micro, small, and medium enterprises in Nigeria. So some very quick facts about MSMEs I feel you may already know, but with the apposite to mention again on this occasion. So 41.5 million MSMEs operate in Nigeria. 90% are in micro enterprises category. 49% of the GDP is actually contributed by these MSMEs. 59 million or 86.4% of the Nigerian labor force is employed by the MSMEs. Now, the implications of all we've discussed, the review, 2021 fiscal, and the outlook for 2022, what do all of this imply for MSMEs? Well, we feel that MSMEs in manufacturing and FMCGs will be relieved by a more stable exchange rate, but higher cost of energy, particularly AGO diesel, as well as levies would imply on their distributable profits, the size of their distributable profits. We also believe that MSMEs in tech would face a slightly higher cost profile due to the new VAT charge on online advertising and other digital services. MSMEs across the country have to identify the appropriate authorities to remit VAT collections to. That means they need to pay attention to the Supreme Court judgment I mentioned earlier. MSMEs in transport, trade, ICT, and finance would record strong growth in 2022. MSMEs would generally face declining private sector lending, as I mentioned earlier, if a substantial portion of government's planned borrowings is sourced domestically. So what are the strategies for MSMEs? The strategies are that MSMEs should target those fast-growing cities like Nnewi, Abuja, Uyo, and Port Harcourt. Is a large growing population of youth in these cities. Of course, it's a different discussion altogether what the disposable income in this environment are. But at any rate, there are opportunities in these cities. Moving on, MSMEs should and can take advantage of these targeted credit facilities by the CBN, quite a number of them, and they are accessible. Then MSMEs should consider cost reduction strategies through by leveraging technology to improve their business operations. Then MSMEs should also invest in skill development and capacity. I found this quote quite interesting. I think we could learn a thing or two from it. Learning and innovation go hand in hand. The arrogance of success is to think that what you did yesterday will be sufficient for tomorrow. Thank you very much. Thank you so much for your attention.